Today is Monday, May 21st, and this is the ADM Investor Services Monday Market Kickoff. Please note the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grains this morning. What does the China-U.S. deal mean for grain futures?
I think over the weekend the market looked at it as positive, like most of the markets that would be affected by this. I think in the last few months we've seen beans drop about 50 cents from their highs because they were worried about China not buying U.S. beans. And we're trying to gain 18 cents of that back today. There is some talk by some of the commercials that China may continue to slow buy beans as they wait for the final agreement and try to get as much as they can from that. The corn market has been in a pretty much of a trading range, waiting for weather more than anything else. But you know, the fact that they're taking sorghum did help corn on Friday. And the wheat market, you know, is not affected by this. And right now, it seems like we're trading weather with wheat down today, with some rains around the U.S. But I think this might be something that takes more of a while to figure out who benefits from it. And some people think that maybe our meat market might benefit more than anybody else because they said they'll import more meat.
See, let's talk about wheat for a minute. On Friday, wheat was up strong, 20 cents or so. What's driving wheat prices now? And are we looking more at foreign markets than U.S. markets? I mean, what are the driving forces of that market?
It's a weather market, and I think on Friday and still today, we're talking about Canada drying out. We're talking about Australia continuing to remain dry, and we're talking about the Black Sea drying out. And so that those areas of the world probably are a little bit more important on Friday. The forecasts for those areas haven't changed, but we saw some good rains that moved across Kansas over the weekend and into the soft wheat areas. So, you know, if I'm a commercial, I'm saying that if the next 3 weeks is right, and we're going to be hot and dry, we might lose a little hard bread winter wheat, but in general, it may not be a game changer for our U.S. crop, and that they'll focus more on wheat crops outside the United States. They think that there might be a little bit more upside in wheat than downside in wheat, depending upon what happens, weather, especially in the Black Sea.
Let's talk a little bit more about weather in the U.S. and worldwide. I know I was up in the upper Midwest last week. They're well behind in planting in the mid 20 percentile when normally they're in the upper 50s to low 60 percentile. What's the latest on U.S. weather?
Well, the forecast for the next 2 weeks is hot and dry, and so when you talk to people around the Midwest, they welcome that because it's been so cold, especially today was wet and cold around most of the Midwest. So I think what happens first of all is that crops get planted on a timely basis, and I don't know if there'll be much change in acres from corn to soybeans. And then we just have to see what happens after that, because there are some people out there that feel that this summer will be a little bit warmer and drier than last year. And so I think a month from now, when we're closer to the 4th of July, we might have a little bit more fireworks than we've had in the last couple of years.
One final question, Steve. What are the funds looking like right now? How are they viewing the grain markets?
The funds are still long a lot of corn, almost 200,000 contracts. Last week they got rid of about 70,000 contracts of soybeans. They're still long meal and they're still short oil. And actually on Friday they went long wheat. So their position in general is a little bit smaller than normal. Long corn and long meal, and short the soybean oil, and not as long as beans. So they have plenty of ammunition to get long if the weather changes.
Alan, let's talk about the financials. The stock market off to a roaring start this morning with the Dow and all the index sharply higher,
right?
Quite friendly. What's going on, and do you believe this will continue?
Well, first of all, we had the Russell 2000 actually advancing for 4 consecutive days to new historical highs. And what's interesting about that is the Russell 2000 is a small cap index that would normally be adversely affected the most by higher interest rates, and yet that's the one that is making new historical highs. So I think that is a very good indication for the rest of the indices to firm up from here. So as you said, we're off to a very good start today, and I would expect to see some additional gains.
Analysts are anticipating 2 or 3 more interest rate hikes from the FOMC this year and 2 or 3 more rate hikes in 2019. What is the outlook for interest rate futures market right now?
Well, with the Fed remaining on the aggressive side, and if our geopolitical problems get resolved to one degree or another, meaning no flight to quality buying coming in, we can expect the entire interest rate futures complex to continue to work lower, probably all this year and well into next year also.
Now, jumping back to China, the U.S. suspended its threat to impose tariffs on $150 billion in Chinese imports to the U.S. while negotiations with China continue. Do you feel that a trade agreement is imminent?
I do. And even the financial markets are telling us that there is something good going to happen with the indices, stock index futures as strong as they are. No flight to quality buying coming in. In fact, we had the 30-year bonds on Friday falling to the lowest level since November of 2014. So the financial futures markets are telling us that there will be an agreement, and that to one degree or another it will be favorable to the U.S.
And with the bonds falling, I mean, does that cast any doubt whatsoever on the further interest rate hikes this year and next year?
Well, basically they would go hand in hand. More rate hikes means lower prices for futures and higher yields. One thing that could get in the way is interest rates in the Eurozone are really not moving up that much as the Eurozone economy remains a little bit sluggish. So that could argue for a slightly less hawkish Fed or less aggressive Fed, but not to any measurable or large degree. There's still going to be at least 2 more rate hikes this year, some people saying 3. So that would not change the trend at all as far as higher yields and lower futures.
Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.